Servitude. 7th floor.
We'll see you around the timeline. Feels good to be back.
I think that Rollup is one of the most premier media brands in crypto, and Andy and Robbie are great experts at everything they talk about, and it's my favorite podcast.
Adding it to my library as we speak.
Potentially multi-chain deployments.
We are at DevConnect Day 1 here. I'm with Jesse from Base. JP Morgan, BlackRock, DTCC, Fidelity, the entire thing was just institutions. It's next level. This industry is going to the next level. And guys, I don't know what else to say. I'm bullish.
He said it, he finally said it.
I'm so bullish.
Andy's bullish, I'm bullish, we're bullish. Is headed to the top. If we're not already at the top, we're going to the top.
We're going.
Rollup is my favorite.
From all walks of life, all over the world, all over this industry, come together for the Rollup.
Zoom out. The institutions aren't coming. They're simply here. It's the golden age of crypto, guys. Get right. Let's go.
Welcome to the nest. See you on the show.
Welcome back to the Rollup. Happy Wednesday. Happy hump day, my friends. It is a beautiful day in the tokenization tower. If you're a Zcash holder, if you're a hype holder, we're gonna get Rob back in here. Don't you guys worry, he'll be right back. But guys, it is a lovely Wednesday, man. Shout out David Shamus. We know Atan loves David Shamus. Guy lives Guy lives just down the road from the boys, huh? Come on. Gotta give some love to Plume, the Nest, powered by Plume, building infrastructure for on-chain asset management, tokenized RWAs. Salman is gonna come on today to talk about their Bermuda license that they just received today. We've got a stack show, guys. You're watching the Rollup, broadcasting live from the financial capital of the world. Today's May 20th, and we have a great show ahead. Let's get Rob in here. We got Mark Wendland of Canton Strategy, more DApp companies. Canton's probably one of the one DApp, one hype, Zcash Canton, maybe the only DATs above water. We've got Lucas Schuermann of Variational following their $50 million Series A and their RWA Perps launch. That one's gonna be a banger. We've got Cody Carbone of the Digital Chamber joining the show as well, the CEO. And then, like I said, Plume, General Counsel Salman joining the show. I'm fired up on Orange Celsius today. Shit slaps. And our topics are powered by Trezor. Trezor.io, use code ROLLUP10 to get your Trezor. Rob, what the fuck is up, man? We're pumping face, brother. Make it all back in one trade on Per and Zcash, baby. Let's go.
It's good to have you back in crypto, man. It's good to have you back on the digital assets. You got caught up there in the commodities. Not going to clown you too hard because the timing's impeccable. The timing is absolutely impeccable. Zcash, hype. These are things that are flying. They're absolutely flying. Which is very
feels
very
like the whole industry is piling into the same trade. What could go wrong? Like, you know what I mean? It is a whopping 88 degrees in New York as well, Rob. I'll tell you that.
Yeah.
It is hot.
It's summer in the city. We're gonna need to keep a tracker. We're cooking some things up on these visual overlays. Maybe we're gonna get a thermostat that just continues to climb on the screen, shows people really so that they can feel the heat of the market inside of the tokenization tower as these markets continue to heat up. Pretty good show today. We've got a banger. A heater, if you will, on a nice summer day in the city.
And the Knicks come back from 22 down to win in overtime. I fell asleep. I didn't even watch it.
That's two in a row. I was busy, and then I turned the game on. There was 3.5 minutes left in overtime. The Knicks pretty much had it sealed up at that point. You could tell the Cavs were just out of momentum. Although I did notice Donovan Mitchell just didn't get the ball. James Harden was complete ball hog the entire overtime period. Yeah. I saw in the last 3.5 minutes of overtime, it was still like a 4-point game. I saw Donovan Mitchell get like the ball one time, and I think he had an assist.
All right, well, we're going to talk about this shot and some other things as well from the Knicks. Before we do, let's get into the market's weather. Let me tell you about Frax, our premier stablecoin partner, open, stable, borderless, the future of digital money. Guys are cooking. They're always on. The future is on chain. As I said, Rob, it is 88 degrees in New York City. It is a heater. It is warm. It is windy, and it's summer. And I think it's a bit of a tease. It looks like the whole East Coast is going to have a bit of a gloomy Memorial Day weekend, unfortunately.
I've got a Memorial Day brunch that I will be going to in my new hometown in a couple weeks or in next week. And then, of course, our friends at Relay are powering this warm weather. They powered the cold weather. Now it's 88 degrees.
They did.
It's a pretty similar temperature here in South Florida. And, of course, the heat is powered by Relay. Send once, arrive anywhere. Relay.link will take you where you need to go. And it'll bring you the weather.
It will. And New Type says Ondo longs are looking great. Without further ado, let's go ahead and get to the markets. I do not have an Ondo long, but I'll tell you, Zcash and Hype both look very, 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 very good. Bitcoin holding above 77, just barely. We need Sailor to keep buying so we can keep the fun going. Near the one outperformer again. We've been hammering that. If you guys have been seeing that, Zcash Hype near, Zcash Hype near.
They're calling this the three-headed dragon. Zcash Hype near. They're calling the three-headed dragon. We've got a special episode for you guys later this week. We're going to be talking about the three-headed dragon thesis. Near, Hype, Zcash.
Yep. So that looks good. Chainlink's firmly above 9.6. It feels like Solana, ETH, and even Bitcoin since the last time we were in the Empire State Building are pretty much the same. I mean, they look relatively, they're pretty much at the same price.
Hyperliquid is at number 11 in
market
the
cap.
top digital assets by market cap. It needs about another 30% move to overtake Dogecoin and land in the top 10. Zcash is at number 14 in the top market cap coins. It's sitting at about 10 billion. Hyperliquid at 12 billion. Dogecoin is at number 10 at 16 billion. Quite a bit more room there. But obviously these things are on the move. I'm finally back.
Zcash looks ready, man.
It looks insane. I'm back above water on Zcash. It's about time. I bought the Pico top of about $600 the last go around. And I had the patience.
Yeah.
Thankfully. Feels good. It feels good.
Wow. You didn't buy any more down there?
I did not buy more down there. Maybe that was my mistake. But I did buy some other things. Akash looks good as well among some other coins.
I thought it was Zcash, Hype, and VVVV. Yes, VVV is definitely a part of this, of course. That thing is absolutely ripping. If you guys watched that show from SmartCon in San Francisco, we had them on. We had Eric on, and the thing ripped. So, yeah. Look, oil is looking strong. The yields on bonds are looking strong. There's some things macro-wise I think macro folks are a bit worried about.
We're worried about macro?
I'm not. I'm worried about the two assets that are just ripping face right now. So that's all I really care about. Shout out to Zama. Private confidential asset transfers on-chain coming very, very soon with their portfolio page. Allows you to send stable coins to any EVM wallet privately and confidentially. So stoked on Zama, stoked to be here. We got news. Let me tell you about Near before we do. Our premier AI partner. I love the air horn. Blockchain designed for AI native applications, autonomous agents. Shout out to Near, bringing AI and crypto together with a great founder in Ilya. James Harden on defense is just not gonna make it, man. Let's play this video.
James Harden on defense is Ethereum's price action in 2026. These two are
holding Ethereum in 2026 is just wow.
Yeah.
I don't know. You keep being bullish on that thing. I'm bullish on tokenization. I think Ethereum is the winner for tokenization. This is where a lot of tokenized RWAs will end up. Like you said, we have Variational coming on later today on Arbitrum. Obviously, Ethereum Rollup. This thing is just, it's just like, you know how if you press the first link on every Wikipedia article, it always goes back to the same article. That's like Ethereum. If you click into anything, it ultimately all goes back. It feels like the value proposition is very indirect. It will be a late mover. Maybe I'm just biased and convincing myself I have bag bias because ultimately, I do think that there's benefit there, but it is taking quite a bit of time to play out. I don't own really any Ethereum. I don't really plan on owning anytime soon. I have my Pudgy Penguin, maybe a little bit of ETH stored away somewhere, but yeah, I'm all good on that for now. Let's watch James Harden and
So the Knicks are down by
14. The Knicks.
5 minutes left, and then they went after James Harden every possession. James Harden is the fattest, slowest double cheeseburger I have ever seen. It's really a simple
Brunson's
game.
Unreal in clutch time.
The Royal Caribbean
some of these floaters off the glass are.
and then roast them like.
That's actually decent defense. That last one, Jalen Bronson just hit it over his head.
The little undisclosed Kalshi ad.
Imagine playing defense like this.
Can't leave the feet. What? That is not a closeout.
Look at this closeout, bro. That was so weak. Splash.
Of everything he's ever made in the NBA.
Look at that.
That's around him.
Down the stretch. He wasn't even trying. What are you doing?
Oh my God, no help.
Yeah.
Dude.
This is awful. And he has no remorse for taking every offense.
Cross just right behind.
Defense is horrible.
Wow, dude, Harden is so fried. Let's flip to the next one. Knicks down by 22 in the fourth. Believe the score was 93-71 with 7 minutes left. Eric Balchuna says he's not sure if he's ever seen a 99.9% chance blown. So up until about the fourth quarter, then the Cavs had a 99% chance of winning, and somehow they blew it.
Donovan Mitchell was completely non-existent in overtime, and I wouldn't be surprised if he's injured or something because they weren't even passing the ball. I mean, I've seen Donovan Mitchell, I think he scored like 60-something points sometime during the regular season. The guy's a machine.
Yeah.
To not even pass him the ball, James Harden, we've seen plenty of that guy in postseason, early stage playoff moments. So yeah, I would be relying on Donovan Mitchell if I'm the Cavs.
Yeah. I would love to just go into this next chart here from our lovely friend McKenna. So hype spot ETFs have reportedly saw $28 million of inflows with zero outflows. This is just in one day. About $5 million average daily inflow. About a $46 cost basis on average. Look, this is one of the most successful ETFs we've seen. We've seen people launch Avalanche ETF, Cardano ETF, Ripple ETF, and everyone's wondering who's the buyer? Okay, great. There's this supply available to institutions to buy, but who's the buyer? And now it's very, very clear that there's a direct buyer here. And so, all in all, this is one of the most successful ETF launches I've ever seen.
Yeah.
And very, very stoked on it.
So Andy, I want to prompt you with a question here. I understand that the portfolio construction is allocated to per, right? Not necessarily spot hype. Can you just explain why you or someone might want to allocate, if they're looking for exposure to hyperliquid, why might someone allocate to per versus the spot hype asset?
Look, I think the spot hype is totally probably the right way to do it.
If you click into anything, it won't.
And yeah, one sec. I'm hearing our lovely guest here. And so on the thesis around per is that MicroStrategy is the one sec, Rob.
Guys, well, we're just gonna take a bit of a break here. We've got some James Harden clips playing in the background. Not sure if you guys can hear.
So
if you
per
guys can
thesis,
hear that. So let me set you up here, right? So as I understand it, we've reallocated away from the commodities. According to Arthur Hayes, this is a bull market. Hyperliquid, Zcash, near VVV. These are all part of the thesis here. Hyperliquid, of course, has incredible fundamentals. The DAT and ETF launches are extremely successful. So, based on your own portfolio construction, or why might someone choose to allocate heavier into per versus the spot hyperliquid hype asset if they're looking for exposure to hyperliquid?
First of all, Mr. Canton OG, good to see you, man. Listen, I think that the reasoning for per is that it has a chance to actually outperform hype. If you watched what happened with MicroStrategy and Bitcoin previously in bull markets, MicroStrategy got up to a 1.5 to 2x premium on the MNAV, which means it outperformed Bitcoin by anywhere from 40-50% all the way to 100% in a bull phase. And so I think there's it's a much more convex, there's a lot more convexity in the trade. If hype keeps going well, per should significantly, right now it's about 1.2x premium to MNAV, but what you can get is 1.3, 1.4, 1.5, 1.7 even, which means hype goes up, 20, 30%, per could go up 40, 50%. And so you get this extra upside, and also works to the downside, that a treasury company like Per can get. Because if they're able to get more earnings per share, more hype per share, they can also activate their ATM. Now that they're actually above MNAV by quite a bit, they can actually buy more hype. They can activate something that all these DATCOs were doing before they all got wrecked. And so Per gives you this asymmetrical upside on a bullish hype movement and allows you to have a micro strategy like return on Bitcoin.
Got it. Yeah, makes complete sense. Effectively a leveraged bet on the underlying asset. Not sure if the use of the word convexity was entirely accurate, but we'll put that aside. And we'll keep.
Let's get our first guest up here, man. Let's get him fired up. We got the Canton Strategic Holdings.
Okay.
So Mark Wendland is the chairman and CEO of Canton Strategic Holdings, which is NASDAQ ticker CNTN. And Mark is previously a partner and chief operating officer at DRW, which means he knows our friend Eric quite well. Eric and I had drinks at Soho House maybe like 3 weeks ago and had a lot of talk about Canton. Previously was also a senior at Citadel, focused on global fixed income and more. Mark, welcome to the show, man.
Thanks for having me. Yeah, it's a pleasure to be there. I think Cernecki was actually your first guest in Tokenization Tower there at the Nest.
That's right. That's right.
Yes.
Man.
Pleasure to be
We
here.
got a fan here.
Right.
I think you got him on the Wall of Fame there, plastered up there. That's a special one. You can only the Wall of Fame is only visible there in person. Mark, we're gonna get you in there very, very soon. But welcome to the show. It's a pleasure to have you. Would love just a quick introduction into yourself and generally how you got involved in the Canton network.
Sure. So as you said, my background spans over DRW and Citadel. I think both firms, large trading houses, cover kind of pretty much every asset class. But one similarity is their investment in technology and how to use technology to scale. And obviously with blockchain and kind of crypto, it is a disruptive technology and kind of changes the status quo of how we look about things. And so it's one that I view. It was always about how to build systems that scale kind of through market cycles, through different stress tests, et cetera, around that. But how do you do more with less? And, blockchain, I think, is one of those technologies. AI is obviously another one, but, this is a powerful technology and we care about market structure at both the firms that I worked at before. And so it was a natural kind of transition to Canton to focus on that effort about how we can use that technology to really change and upgrade our systems, more about rewiring our financial markets and the plumbing associated with it.
Yeah, man. One of the things that Canton's been really kind of known for is their work in the repo market, right? And just kind of like all the things that they're doing there. I think also as of late, DTCC plans to tokenize part of its treasury on Canton as well.
Yeah.
Sorry, guys. Maybe you could just talk about the DTCC plans to tokenize, what that means for Canton, and kind of like how that growing relationship between obviously, one of the largest institutions in the world, how that came about and what that means for Canton.
Yeah, I mean, before I get into specifically with DTC, maybe just kind of double click a little bit about what I think of tokenization kind of means, because it can mean different things. And one of the use cases that I'm going to talk about tokenization is tokenization of treasuries, which as it relates to the mobilization of collateral. So collateral being used across like even just the derivatives marketplace is just a huge opportunity. So that collateral used for OTC and listed, it's over $2 trillion worth of collateral. So it's lots of TAM that can be used associated with that. And when you think about non-cash collateral, the number one use case of non-cash collateral is treasuries. Entered DTC as the largest CSD in the US and frankly, I think the globe. And all kind of US treasuries flow through their four walls. And so by them tokenizing a treasury is as native of kind of issuance you can get on chain in that kind of waterfall. And so it gives that it is a security. It doesn't matter whether it's a tokenized security or it's Fedwire or other means. It's just one security. And that is key component to make sure we don't have fragmented kind of systems and liquidity pools associated with that. But I think one of the biggest use cases is, again, around this mobilization of collateral, which isn't necessarily the most sexy piece, because there's other benefits of tokenization of assets about operational liquidity, making access to assets that otherwise weren't there. But the collateral mobility is often lost, but there's a huge benefit from financing cost. So just talking about how the margin process works for the derivatives industry, when you post non-cash collateral to the exchange or to a counterparty, you can do so same day. But when you have excess, so the market moves in your favor and you want to pull back, that can take multiple days according to their rule book or the structure of the transaction to get that collateral back. And so you're just sitting on exposures. So from a credit risk perspective, that reduces the friction there, but the funding cost of then being able to deploy that capital or that collateral more thoroughly in your system, like that's a huge unlock. And obviously, crypto has been very heavily involved in kind of the evolution of blockchain technology. It's just now trying to get that into our traditional markets, which are just built off of legacy systems.
Yeah. Mark, the thesis that we've had is that, first the tokenization thesis will play out in such a sequence, to the extent where, first we'll tokenize these things, and we'll do that essentially start with the lowest risk things, then go down the risk curve. And we had Carl from Six Man Ventures on here yesterday talking about the attractiveness of some of these assets follows a barbell approach. There's things like equities on one side of the barbell and things like cash and treasuries on the other side. Eventually, we will tokenize all of these assets. They will be on chain. The next step in the sequence is that these will flow into these DeFi primitives, these lend borrow things, become composable with one another's across venues. And so, for instance, given that the DTCC is sort of in a position where it is central to a lot of, the financial activity that's happening in the traditional world, I take it they're going to take a rather conservative approach. They're probably not going to be looping or staking or, lending out or doing some of these things with their holdings, even though that being on chain allows them to do so. So what would be the primary benefit for this tokenization process? Is it a direct benefit to the DTCC itself, or is it kind of laying the foundation where it would allow a lot of the companies, the issuers and the tokenization companies to operate more effectively on a tokenization foundation?
Yeah, so I think it's the latter is the short answer to what you're talking about there. But I think the way that you laid it out is it's an evolution around it. It's not going to just automatically jump to the end state where we get some of the benefits in the DeFi market around looping, staking, et cetera. It's going to be a progressive approach around that. And I think even from DTC's pilot program that they've talked about, they're starting with treasuries, and then obviously they have other assets like equities, corporate bonds, munis, et cetera, that can benefit from as well. But let's start with the basics. Let's actually show there's value. There's this technology can work. And here's a simple example around financing benefit that relates to anyone that kind of post margin has to use collateral to means to support their business and prove that value before we invest so much more to integrate that across our other workflows and other assets that we will go across it. Like equity market structure is just more complicated than the treasury market. And so I think it's a good starting point. And again, you can show that economic value to warrant the continued investment to go down the spectrum, as you said, risk spectrum of different assets and so forth. But I think the easiest one, and it's kind of like very obvious to anyone that's been in short-term markets, repo markets, financing markets, about the drag associated with that. And once you kind of see that play out in real work, then you want to say, how can I leverage this across all these other things that I do? And that's just, again, from financial transactions. There's operational workflows as well. Smart contracts are just a very powerful disruptive technology.
Yeah. So, I think there's plenty to say about Canton Network, but, like we said, we had Eric Saranecki in the tokenization tower. We talked at length about the validator set, the permissionlessness of the network, and ultimately what the vision is for Canton, as well as all of its validators. Given that, you're at the helm for Canton Strategic Holdings, let's talk about CC, the Canton asset. I'm curious what your vision is for Canton, the asset, given that, it's got this large set of validators coming from essentially every swath of, the economy. There's a lot of potential here, but it feels as if none of this has really been turned on or activated. At what point do you foresee Canton, the asset, really starting to capitalize on the growth of the Canton network? And as an allocator, as part of this holdings company, how do you plan on playing a role in the network?
Yeah, so let me first just kind of describe what I think of Canton Strategic and what we are and how we play. So we're the first publicly traded company to leverage Canton Coin and support the Canton network to advance this institutional blockchain adoption that we talked about. And so obviously there's an element of digital asset treasury supporting the coin, accumulating the coin as a feature of it, but that's not the sole purpose of it. It's also to help grow and participate in, a healthy, vibrant lending market around Canton Coin, an options market, all of these things, very early days associated with the launch of the network. The coin just was listed back in November, shortly after our launch. So very early days. We're helping support these, activity. We have access to capital markets, and then also investing in the ecosystem, investing in applications that are building on top of the network. There's been some, new CIPs over the last several months that kind of align incentives amongst different market participants. So super validators, in order to participate, that you have to lock a significant amount of coin in order to participate that, which I think is a good aligning incentives. And obviously, as a holder of a large portion of tokens, we have the ability to help out those that potentially need tokens in order to do that. There's one that's being actively discussed right now about applications that featured apps would also have to lock tokens around that. So those are all kind of evolution, I would say, of the Canton ecosystem becoming more mature, more auxiliary markets around that where we can help participate, but then also investing in applications that are going to build upon it as well to give shareholders a diversified, enhanced revenue stream associated with it than just buying the token itself. That's how I kind of think about that. I view it's still early days, especially that we published our Q1 results a couple weeks ago. We also, in our PR release, tried to talk about a little bit some of the Q2 things that have happened, because I think this is a very fast time and evolution of an early chain.
Yeah. Mark, one of the things that Rob asked me earlier was about, this idea of buying the underlying or buying kind of like the treasury company or this kind of like strategic company. And I'm curious, you kind of just got into it there, but when it comes from an investor perspective, from an idea of understanding like the benefits of owning the underlying versus owning something like CNTN, obviously not financial advice here, but what is the core reasoning for understanding the investor who wants to allocate to CNTN versus the underlying? Is it exposure? Is it access question? Is there something more that Canton Strategic Holdings can drive rather than just owning Canton itself? How do you kind of think about the discrepancy in ownership of the underlying versus the treasury company that's traded on the NASDAQ?
Definitely happy to. So the short answer is I think you want exposure to both. I think they're both great investments, obviously. But I think about the investor has to look at what is their primary objective, what is their risk tolerance, what is their operational means. Do they have a broker account or do they have a wallet? Some don't still invest in crypto assets. That's not necessarily, that will obviously continue to evolve as it becomes more mainstream. So if you think about, there's other examples where there's different lookalike type instruments that give a slightly different aspect. So if you look at the fixed income U.S. Treasury market, you have the U.S. Treasury. You can buy the bond itself. You could also buy a future, and you have different characteristics that investors like. The tax treatment associated with the future versus the outright bond, or they do an interest rate swap as an element to invest as well. So I think it comes down to their goals and objectives. I think CNTN gives, again, a more enhanced return on top of the coin. It's a publicly traded stock, so you're able to hold it in a broker account. You're able to probably use it more as means of collateral or cross margining against other types of assets, getting leverage if that's something that's important to you, than doing in the coin itself. But I think, again, this whole ecosystem as well will continue to evolve around it, but it goes to what your tolerance is around that. And we haven't talked about this, but obviously there's also now ETF as well associated with it. But again, there's pros and cons about that as well. So now you have two publicly traded vehicles associated with it. The ETF is meant to mimic more the coin itself. And so you pay for that access, and there's a management fee and so forth. Now CNTN is a cheaper way. You don't have that aspect of it, but you then have an enhanced return on top of the coin. If you're getting more exposure to the ecosystem as a whole, I think via CNTN. So it comes down to what each investor's appetite is and what their goals are. But I don't think you can go wrong with any of the three that we just talked about.
Yeah. Just a more general question here. Given that you've got an extensive history in finance, you were COO at DRW, and just generally through your experience, what do you find most compelling about Canton Network that's not offered by other blockchains? What do you find most exciting about this?
So I view what Canton did very well is they listened to what institutions were, what their requirements were. And so, that configurable privacy element was something that was a gatekeeper. That was like, allow us access to this. That was the only way you could kind of crack that. So what really interested me personally associated to Canton was because I like I like solving problems. I like figuring out how to improve. Like my entire career at those two firms, that's all I was focused on. How do you do more with less? How do you really scale those things? And doing so that improves market structure. And I think this is an example of where Canton listened to what the requirements were when you're dealing with regulated institutions, with regulators, and built a product that was focused towards that. That doesn't mean that Canton is the blockchain for everything. I think that's also a common misnomer, as that one blockchain can do everything. I don't think that's the case. And I also don't think if our financial markets are all on top of Canton, obviously that would benefit us, but that's also a bad market structure to have too much concentration on one blockchain versus others. So I'm sure there will be an evolution around that as well. But I was really drawn to Canton because it built a product that I think could be a game changer in rewiring what was a very archaic way of settlement flows on top of legacy rails.
Yeah. And,
Yeah.
one of the things that we've seen come out just over the last couple of days is this proposed innovation exemption from the SEC. This seems to have, really accelerated tokenization because we may not even need issuers to opt in. It could just be done at a third-party level. But there is a configuration, as you're talking about, to maintain the shareholder rights of a lot of these products. And it seems like maybe Canton is more in a position than others to configure certain parameters that could help to maintain shareholder rights, whereas others are hands off. They say, no, we're not going to touch this. Anyone can deploy anything, doesn't have to hold any rights, to these assets. How much do you think it makes sense to enforce some of these rules at the asset level versus just stay hands off and just kind of let these builders, do what they think is right?
So I think the SEC, how I read that article and that announcement there, was just another example where this administration is, leaning in and trying to promote innovation. So they've talked about this innovation exemption about it, and they want to be seen as propelling that. Now, the flip side of it is that the details actually matter associated how they plan to do that. But I do think that they have shown what they want to do is they want to create, this right balance between the innovation that this technology can deliver, and then also preserving the investor protections that the SEC has mandated to do as well. And so I think the details will flush out exactly what that looks like, and I'm not sure exactly which way the wind's blowing. I don't think anyone can kind of see exactly which way this administration is gonna go. But I think what they do believe in from conversations as well is they believe in one market structure if done right. We're not talking about whether this stock or this treasury is tokenized or whether it's on the old rails or not, because I don't think it will ever be 100% one way or the other, but it's just an asset. And so that's the dream scenario. I think there's definitely been some efforts now of some tokenized assets and so forth that have different risks associated with it. Lookalike, does it have the same protections as you would have through the old rails? And I do think we will get to the right answer around that. But I'm very interested to see what the details they flush out. I know they want to continue to make sure that it comes onshore versus going offshore, which is obviously what's happened in the past. But I think the details actually matter associated with that.
Yeah. You know, one thing on the privacy side, I'm curious if you've had, you know, or seen or talked to the team about any kind of, you know, pushback from institutions or folks who are looking to use the network with regards to the private payment model or the kind of privacy model. Has it been mostly positive? Has there been pushback? Like when it comes, you know, you talked about the configurable privacy being very important. When it comes to that aspect, what has been the response from the institutional allocators and clients, you know, that you've pitched this to on the buy side, or that, you know, teams that have been working with more directly as super validators, whether it's Visa, DTCC, NASDAQ, et cetera, just kind of get a bit of a temperature check on the privacy side of institutional allocators?
So I would say they've all kind of unanimously said that it's a requirement. It's more, this is what we need. It's a table stakes. We need this in order to kind of get comfortable with putting our flow on top of this in large scale. So I think that's the overwhelming kind of consensus we've seen from those conversations. But I will say, like, part of this has been an education about explaining what it means and how it is. You know, I thought there was actually a good piece that came out this morning that was a good overview of the Canton network as well. But I think that's frankly a lot of the time over the last 6 months has been about educating people about what the network, how it works, the tokenomics policy associated with it. And we continue to have those conversations. It's definitely gaining momentum around it, but it's still not quite crisply understood. But privacy, as far as that, I think it's a table stakes. Everyone's kind of said this is a requirement we have to have.
And I think this is true at the enterprise level, institutional and retail. There was a tweet that went pretty viral just this morning about someone paying their like crypto card statement. And they paid, you know, like it was like pretty pricey. So they got some good cash back. But everyone, you know, payroll, credit card statements, all enterprise payment, you know, all of these things require some semblance of privacy. It's just the way that our world works at this point that, you know, we don't have our financial information publicly available. How, you know, I guess my question here is, one of the main value propositions of blockchain is its composability, and this can be both a feature and a bug. How do you maintain some of these things where we can get, you know, open composable finance where these things move really efficiently, everything works together in tandem, but you maintain privacy? You know, this feels like if we can harmonize these two things correctly, there's a really big opportunity. But we know institutions and really everyone need privacy in order to operate effectively. They're also kind of foregoing one of the main value propositions here. How do we square this circle?
Yeah, so I think you hit on two different type of topics, so I'm going to answer them both. So the first is on more the composability, the interoperability. And so as it relates to Canton, it's all kind of one L1 network. And so you have kind of a network of networks where each application has its own configurable privacy element of this application has 10 fields and 8 are public and 2 are private. And this other one over here has its own set of rules of what are public and private. But all of it is collectively composable across. You don't have to transition across an L1 to an L2. You don't have some of those bridge aspects of risk that can come into the system, but you have the composability across that. So a network of networks that kind of solves for some of that interoperability kind of component. And then again, the second part of your question about how to, do it in scale and do so where you get that confidence associated with balance between privacy versus what's public in trade reporting in the fixed income market, equity market, the tape, and so forth. There's already transparency out there now. What the time delay around that activity is been debated and so forth. And so if done right, you can have the right people know all the information. Like if you think of regulator, they can see all of those 10 fields on that first application that I was talking about, those 2 that were private. But the public sees a trade took place at this price, and it's public out there. The name of the person who does it doesn't really add much value associated with it. Right. So it's using that kind of atomic settlement, that real-time access to the information that you really need to know, but it doesn't do the disclosure of the names.
Yeah, very cool. Mark, this makes a ton of sense. I'm just, curious if you have any closing thoughts here. There's quite a bit of fervor around a very tight subset of the market. Privacy is very, very important to this. We've got the Z caches and the private uncensorable AI. There is a quite a bit of interest and demand around privacy in the current market. And so I'm curious, given that it feels like it's a really intense bull market for, kind of a choice select assets, how are you making sure, contributing to, getting CC, Canton, CNTN, a seat at that table? Because it feels like like I said, there's a lot of attention and interest in a small cohort of assets right now, but not necessarily broad spectrum. So how do we, ensure that Canton makes it into that subset?
Yeah, so for myself and Canton Strategic, we're participating in all areas of it and the evolution around that. So we're participating in the foundation. I'm a board member of the foundation, participating in the governance of the network, participating in the infrastructure by being a super validator and validator around that, investing in the ecosystem, trying to make this happen. So how do we actually get this to be success is continued more volume. So we need, some of these kind of milestone that we talked about before, DTC tokenizing a treasury, then moving on to other asset classes around. That will be huge unlocks to get, from 1 million transactions a day that we're doing now to hopefully 2, 5, 10 million transactions as it looks to scale. And that's what we're trying to do. Again, this is early days associated with that. It's a marathon, not a sprint, because when you deal with these regulated institutional type flows, you get one bite at the apple. And that's, I think, the way digital asset and kind of even their creation and evolution around Canton is, digital asset's been around since, 2014, I think it was. And it wasn't rushed to market to pick up some momentum. It was frankly learning from others' mistakes and their own mistakes and trying to then get to a point where it's ready for prime time to be used across this flows. And, it's early on that stakes. It's been around for 2 years. I'm really excited about what the next 2 years is going to look like. I think it's going to be fast and furious and a lot faster than probably most anticipate. But we have the groundwork now. We just need to execute.
Love it.
Epic. Mark, thanks so much for coming on, man.
We're gonna have to get you on when Canton hits $1, man.
There we go. I like it.
Absolutely. Let's do it. Yeah. So we'll do that next week.
Sounds good. Sounds good.
All right, Mark.
Thanks, Mark.
We'll see you next time, man.
All right, buddy.
Bye. All right.
Man, Canton just is so stable. Like it's so just just a 15-cent stable coin.
It is. It's been that way for so long, and it feels like they've just got a tight control of the supply over there. Market makers are putting in some serious work. Whenever it's time for that thing to go, whenever they choose to dial the pump, man, it feels like it's gonna go.
That is how it feels. So,
all right.
I mean, that trade, while it's been, in shambles for a while, there's a couple of these that are at a really strong spot still. So you gotta love it.
Yeah.
Well, guys, we got Lucas Schuermann of Variational up next. He is the founder, big launch, big raise, and let's get Lucas up. Lucas, man, welcome to the show. Good to have you. Congrats on the raise announcement.
Great. Thanks so much. I'm excited to be here.
Absolutely.
Yeah,
Congrats.
Appreciate you working with us through the time zones.
Absolutely.
Yeah. Lucas, perps feels like the modality of the future. It feels like everyone is excited about bringing what we've called high quality assets on chain. You guys have raised $50 million to do just this, to bring RWAs on chain in a perps modality. Would love, a bit about the story, as first, maybe, about yourself and Variational, and then we'll get into the raise in particular.
Yeah, let me share a little bit about that. It's one of my favorite topics. Like, who doesn't like talking about themselves, right? I'll try to keep it. Yeah, exactly. I'll keep it succinct, but there's some fun nuggets here. I've actually been in the broadly like quant trading, high frequency trading, and crypto space for the last 10 years or so, working the entire time with my co-founder Edward Yu. We started out after meeting at university in Columbia, in New York. We're kind of a dorm room founding story. I was the first person he met on campus. We were adjacent in the dorm room halls, and we quickly became friends. We were in similar research labs. He studied applied math, I studied computer science, and we were all working on kind of topics in machine learning and Bayesian stats and kind of these types of things. We ended up, being very close throughout college, and we started a hedge fund. We were crazy enough right out of university. This was called Q Capital. It was in New York. We ran that for a few years, raised some pretty large rounds to the GP and then a large LP seed. We were actually acquired by our Series A investor, Digital Currency Group, Barry Silbert's firm. And then I spent some time at Genesis Trading as the VP of engineering. Ed was the head of quant research. Genesis Trading was one of the largest OCC desks in crypto at the time. So we helped them build out their single dealer platform, electronic market making system, lots of other really fun infrastructure. That was kind of during their hyper growth phase from 2019 to 2021. So it was a great seat in the ecosystem to kind of see everything that was happening, build up many pieces that are similar to the things we're working on now, and build a great view of kind of the ecosystem. In late 21, heading into 22, we left Genesis after kind of finishing our time there, and we started Variational. Variational's early time was actually, this is not as well known, it was actually as a prop shop, like kind of a prop trading firm. We were very active in OTC derivatives, like OTC options, as well as on a lot of other DeFi protocols, kind of from the 22, 23, 24 era. So if you can name one of the protocols from that era, we probably had some form of a tendril in it. We had some wins, we had some losses. It was a very volatile time in the markets, as I'm sure you guys remember, with Luna and FTX and everything, but also tons of innovation happening. That's when DYDX was really hitting product market fit, and also the earliest versions of Hyperliquid. So we've been around the block, we've kind of seen it all. And, I like to sometimes compare our DNA, our story, to a few of the other successful teams in the space, coming very much from a trading background of the last 10 years, HFT, and then kind of that dorm room founding story and bond that I built with Ed. So it's a fun one.
Yeah. Robbie and I also share a similar dorm room founding story from freshman year at the University of Florida. We don't need to get into all of that now, but what has been one of the biggest obstacles or challenges to building Variational through the years? Like, what has been a persistent kind of obstacle, or what wasn't as easy as perhaps you had anticipated it to be up to this point? And then similarly, what was easier than you expected to build such a successful app?
That's a great question. Well, to be honest, the crypto markets are brutal. I feel like all of us have been through so many ups and downs and phases and cycles over these last, 5 to 10 years that we've been in this market. Wouldn't trade it for the world, but that's the real answer to your question. So, truly, which do I even pick? I'd say one of the biggest challenges probably was trading through and being very active in DeFi and even on centralized exchanges around the time of the Luna collapse, the FTX collapse. It taught us a lot of lessons about risk management, about kind of mistakes that were made that we saw that have informed our perspective on how to run a successful protocol in this space and how to try to defend against that. I also think this is where we started having the first seedlings and idea of moving from doing more of like quant and prop trading, which we had done for 6 to 8 years to that point, and starting to think about building. We saw some gaps in the market, right? We saw that there were pretty limited tools for people to kind of face each other peer-to-peer to settle and clear things on chain. And I think this is one of the big reasons we saw, not just with us, but with Hyperliquid and many others, kind of a new renaissance and resurgence of DeFi as a trustless way to be interacting or transacting in these types of derivatives. So that was one that I saw amongst many other stories. I'm sure you guys remember that time in the market, but those were crazy days. On the plus side, I would say I've been really happy and proud with how the team pivoted from, frankly, like very, very different types of products. Like, of course, there's a lot of pieces within Variational's overall architecture that look like trading and prop trading infrastructure, and we're solving a lot of the same problems. That's why so many trading teams, I think, end up in having a lot of success kind of building in DeFi. But on the other hand, there was a lot to learn, right? Everything from consumer marketing and growth all the way over to how we interact a little bit more with directly building and deploying on-chain primitives, the security related to those things, and so on and so forth. But I'd say that the team really spun up very quickly there. And at this point, now that we've hit some product market fit and had some success, the growth story is compounding, and it's really great to see the team kind of come into its own.
Yeah. Incredible. Lucas, let's not bury the lead here. You guys closed one of the largest fundraise Series A rounds for DeFi in 2026. Dragonfly is the lead. Dragonfly is one of the few funds that is able to close or lead these rounds at this scale as DeFi matures. Variational also launched RWA perpetuals today. And so it feels that like these are related. This was a strategic decision to announce their fundraise at the same time as launching these perpetual markets for RWAs. Why choose to launch these two things together? Why the RWA focus and the fundraise here at the same time? How are these related?
Yeah, great question. I mean, we really view these as two sides of the same coin, all right? Like, our investors kind of arrived at their conviction because of our RWA roadmap. This is something that Variational's been building towards for quite some time. In fact, as I'm sure we'll cover a little bit later in the pod, Variational uses a very different type of overall design. It's not a CLOB, it's not an order book, it's RFQ with kind of aggregated liquidity. And we've been using that architecture intentionally with an eye towards bringing some of the TradFi liquidity, or let's say all the TradFi liquidity on chain. So this was the vision we were pitching when we talked to investors, not just recently, but honestly many months and even years ago. And I think that's kind of the big thing that everyone's been waiting for. So why work with Dragonfly? Why announce these things at the same time? I think principally we partnered together to tackle RWAs. We partnered together to bring TradFi liquidity on chain. And I think it makes the most sense to tie these and show like, hey, these are the level of buy-in, commitment, and institutional capital that we have to deploy. And we're very serious about solving this problem.
Yeah. And I mean, Lucas, I'd love to just have you extrapolate a bit about the vision that you have for Variational. I think that a lot of the industry has been kind of pigeonholed into this idea of we're building all of these DeFi protocols and applications for the crypto asset ecosystem and kind of what that entails, all of the traders on chain, all of the assets on chain. But Rob and I have been very firmly, pushing this idea that this tokenization spectrum, starting with stablecoins, high quality, low risk assets, moving all the way down the risk curve to equities, to private credit, to anything that you can really kind of fathom from a higher risk perspective, is well underway. And just yesterday, there was some news from the SEC that came out about a tokenization innovation exemption as well. Kind of what is the broader vision here for Variational? I have a feeling it's not just trade Bitcoin and ETH up to 100x 24/7. I think there's something bigger here. What is your kind of like top-down vision for what this app can become?
I'll answer that in two parts. So I'll give you on the consumer side, right? I think, as you said, it comes from being user-focused, right? We're not interested in building tech for tech's sake. We're interested in solving problems that are like what on-chain users actually want to trade. And I think exactly as you said, on-chain users want to trade not just what we have currently, which is 450 different crypto markets, all with market-leading liquidity, all with zero fees, all on-chain as perpetuals, but they want to trade the same level of UX, deposit and go, zero fees, et cetera, but on perpetuals and CFDs for hundreds of different TradFi markets, right? They want to trade stocks, they want to trade commodities, they want to trade global equities, not just in the US, but they want to trade them in Korea and Japan and beyond. And we've seen this demand. I mean, let's also not talk about the elephant in the room too much, but of course, Hyperliquid validated that this is like a massive, massive market. And I think I agree with you that it's only going to expand. But fundamentally, what we see in the market is everyone's kind of solving it in the same way with the same limitations, which is every time we build a new order book, we have to bootstrap liquidity, which means it takes some time to find those dealers, find those market makers. And for the majority of listings that we've seen in the market so far, we find that they're pretty thin. They're difficult to trade. They have high execution costs. So we're listening to the users. We're seeing the exact same thesis that I think you just mentioned, that users want to trade everything in one place. They want to have access to global markets with the same quality liquidity that they're used to in TradFi. So this is bucket one. I promise a two-part answer. This is for the retail side. Let's say for the the everyday trader. Our vision is trade hundreds of different perps and CFDs, not just crypto, but all of the global markets that we can get our hands into with TradFi quality liquidity, and that's what our model enables. The second part, though, as you alluded to, is we actually have a product called Variational Pro, and it's something that we don't get too deep into right now since there's so much that we can do with Omni and so far that we can take the retail perps trading side. But as I mentioned, our background actually comes from institutional trading, OTC derivatives, structured products, options, and we see a world out there, applications of Variational Protocol, not just to retail trading, but actually to helping to solve the ways that institutions trade options, hedge with structured products and beyond. And I share that exact same idea. As we see more tokenization, a better kind of regulatory framework, we'll see not just retail, but institutions having a massive uptake in these things. And we can build a product that helps solve both at the same time. And that's something that really excites us going forward.
Yeah. And Lucas, let's kind of just get your opinion on why perp as a product is a superior product to, 0-date options or very short-term options. Why do you feel that perps are a superior product?
Perps are simple. That's really the key idea, right? What do you want when you're trading a derivative as a retail investor? You want the ability to long or short, right? You also want the ability to trade with leverage and to kind of express a size in your position. But what you don't want is to necessarily think about all sorts of time decay of your Greeks and your higher order risk factors and these very nuanced things that relate to options trading. I think 0DTE options and some of the other types of tools we've seen built for retail traders are amazing. I actually think with AI, we'll see a little bit of resurgence of retail users trading these things as AI tools and LLMs can help them with trade ideas, with digesting and thinking through different types of constructions. But A, we're not quite there yet. I do have some interest in solving that problem later down the line. But B, the reality is perps and CFDs, they're simple. They change linearly with the underlying. They give me everything I want as a retail trader, which is, again, long and short and some leverage, and the ability to use USD as collateral, or USDC, but without kind of adding all that extra complexity that I think a lot of users honestly fall prey to.
Yeah. Lucas, looking at some of the stats here, obviously this is with very, very recently launched RWA markets. So the full suite of products is starting to become available. I think also it's still restricted in some geographic locations. But even despite all this, upwards of $4.5 or so billion of volume over the last 7 days. And I think upwards of $16 or $17 billion over the last 30 days. So there's still significant volume here. With the most recent raise, $50 million from Dragonfly, how do you plan on utilizing this capital to accelerate open interest, accelerate volume, and take this thing to $50 and $100 billion?
Yeah, I point out that our first set of RWAs, as you mentioned, just went live quite literally last night, Asia time. So let's call it 24 hours ago or so. What this means is the existing kind of traction you see on the platform comes from our zero fee model, our aggregation of liquidity, which gives high quality execution to our users, and the huge menu of things we have to trade on the crypto side, these 450 different perps. But fundamentally, the thing I'm most excited about, and Dragonfly is most excited about, and we're really happy to be getting out into the world today, is that the vision here is not just 450 crypto perps, but it's hundreds and hundreds of additional RWA markets to trade. So what are we using that capital for? Well, fundamentally, the problem that we're solving, to put it more succinctly than my earlier answer to Andy, is we're bringing TradFi liquidity on chain, right? Like that's fundamentally what our architecture enables, and it's fundamentally what I think is missing, kind of the missing link to not just have 5 or 10 different tradable assets like we do currently on chain, but to have that huge menu. So it takes capital, it takes real institutional might to partner with tier 1 US institutions, with those big TradFi players, dealers, market makers, and others that you have to in order to solve that. We've solved it on kind of the protocol architecture design, and we've proven the model to what you just mentioned in terms of our existing volumes and stats. But I think we'll see an exponential increase from here. Of course, that's what I hope. I'm drinking my own Kool-Aid. But I think the demand's there. I think that the product is really going to be a step function once we start rolling out these phase 2 markets, is what we call it, these TradFi liquidity porting on chain. And that's coming in the next few weeks.
Yeah, and we know that there's significant demand for this modality, and this can be applied to all asset classes. Given the size of the asset classes that are starting to become available on Variational and the quality of those asset classes, I'm curious, do you anticipate that trading volume open interest will, in these RWA markets, will eclipse that of the native crypto assets? And if so, how long do you think until you end up with greater than 50% of the open interest on Variational is in these RWA, either equity, RWA, commodities markets?
The short answer is very soon. And I can give you some data on this, right?
Sure.
We'll see a very similar path to what we've seen on Hyperliquid with HIP3 and Trade XYZ. Love their team, love what they've been doing. But to the point of them validating the market, I mean, to my knowledge, more than 50% of Hyperliquid's volume and probably a pretty similar percent of their OI is now driven by RWA markets. Probably changes a little bit on a day-to-day basis. But I think Variational will achieve a similar parity very soon. Frankly, it depends on the market cycle. But right now, I think many retail traders are more interested in trading, say, AI stocks, memory stocks, semiconductors, these types of things, than at least certain mid and long tail crypto assets. Of course, cycles change. There's always kind of a hot new thing, which is great. But our goal is to give that full set of optionality to retail users on our platform so they can trade whatever they want all in one place. But I really think as we roll out more markets in the coming few weeks, it will happen very, very soon. HIP3 showed the adoption curve here is fast if you provide a high quality product. And again, I think they did a great job, but I'd say there's high quality execution on 5 or 10 markets right now there. I think we'll be able to do so on 100 plus, which is going to be very, very exciting.
Yeah. Lucas, let's talk about some of the design choices that you guys have made, specifically around the way that the taker and maker orders happen, as well as around kind of the RFQ system, which will kind of lead us into the revenue and buybacks and this whole conversation. Why do you feel that the variational RFQ model is superior to the order book model of something like a Hyperliquid?
Yeah, I think fundamentally RFQ and order books they're different sides of the same coin, right? They're at the end of the day ways to match orders. So I also want to draw a distinction that limit order books are great. We rely on limit order books. They're used for price discovery. Exchanges are necessary to Variational and to the markets in the same way we have Hyperliquid in crypto, but we also have NASDAQ and NYSE and CME and all the other traditional exchanges that you might be very familiar with. But also in traditional finance, we have this idea of kind of brokerage style, let's call it liquidity aggregation or routing, which essentially means that rather than being the infrastructure layer play, for most retail users, what they want is access to the most liquidity. They don't want to trade on just one book, which might not be the deepest book in the world. They want to trade on as much liquidity as possible. In other words, get the lowest execution cost so they keep more of their profits. This is really what we're solving for with our model. So what's the difference is we're not trying to be the venue for price discovery. We're trying to be the venue for best execution. And what that means is rather than building a limit order book, which is again used especially by algo traders for that price discovery and really rapid level trading, RFQ allows us to quote a really, really excellent price all in to the user on the one side, and then aggregate the liquidity on the other end for hedging on the other side. So this is the fundamental difference in our model, but it's also the fundamental thing that allows us to bring that TradFi liquidity on chain rather than trying to rebuild it every single time we do a new listing in a new order book.
And then does that, because you have a zero fee model on that, on the platform at large, does that end up looking something similar to how Lighter has a zero fee model, but then earns revenue via effectively by market making, and then is able to do their buybacks? How do you guys generate revenue that will ideally for the community end up being used for token buybacks for a future token? I know you can't speak probably on the token side, but how does the revenue generation on Variational work? And kind of generally, do you have any plans to change that, to accelerate that? How does that process work?
Yeah, so Variational is revenue generating right now, despite our zero fees. And our goal at the end of the day with this model, again, as I said, is liquidity aggregation and high quality execution for users. And a big part of high quality execution is zero fees. So, but it's a great question, a very fair question. It sounds sometimes too good to be true. If there's zero fees and great execution, how does Variational make money? Just a quick point of kind of explanation. You were mentioning Lighter, and I'd also use the example in traditional markets of, say, Robinhood. These are other zero fee trading platforms that make what's called a payment for order flow. So that's what you were just alluding to, which is the idea that they don't have to charge their retail users fees, but they make money by selling the order flow out to market makers who are filling the other side of the order. Selling the order flow, I think, is, let's just say, there's been many articles written by people smarter than myself about the potential game theoretic misalignment there. But let's just say the money has to come from somewhere, and the market makers are the biggest beneficiary of this arrangement. In fact, they're usually kicking back a small portion of the profits that they make to the platform where they bought the order flow from. It makes intuitive sense, right? They're not going to pay more for the order flow than they can monetize themselves. On Variational, this is the other side of our coin for the architecture. We talked about RFQ and liquidity aggregation, but the other big kind of difference between Variational and other platforms is that OLP, Omni's liquidity provider on Variational, is the system that takes the other side of retail orders immediately. So for every retail trader, they're what we call a taker. OLP is always the other side of the trade, the maker. OLP's job is to then go and aggregate liquidity to hedge it as cheaply or as quickly as possible. But in other words, we're able to so-called, I like to say, squeeze the limit or juice the lemon before we do that. We are the maker that can kind of juice the quality of that retail flow a little bit before we pass it along. But this is a win-win. We provide zero fee trading to retail users. We aggregate a lot more liquidity, which gives them high quality execution. And then we are able to kind of keep it within the platform. This monetization of the retail flow is what we'd usually call it, to a very small degree. And then we go and hedge it ourselves. But in the past, we've used mechanisms like loss refunds. In the future, we're planning on something called a spread rebates or other types of rebates on the platform. But our overall vision is to keep that revenue source within the platform rather than leaking it out to the market makers and then having them kick a small amount back through PFOF. We want to monetize it within one platform and be able to share some of that with the users. Or frankly, just take a smaller spread at the top line and zero fees, which is another way of sharing the value with the users.
And then you plan on having zero fees, no pun intended, but perpetually for the existence of the product?
Yes, correct. Variational is stable and revenue generating without fees. And again, conceptually, we can compare it a little bit to payment for order flow, but imagine instead of sending the order flow mostly to be monetized by the external party and then getting a little bit of a kickback, Variational attempts to squeeze that lemon on the other side of the retail orders directly before hedging. So this is the fundamental mechanism by which we generate revenue, but it's a kind of a win-win-win.
What do you mean by squeeze the lemon in this case? Like when you're talking about juicing the order flow before passing it off to the market makers, what is that process?
Fundamentally, it just comes down to the efficiency of hedging and how we can efficiently aggregate that liquidity out. So this is the same that any other market maker would do. In the same way, Citadel might be on the other side of a Robinhood trade. Once they assume the other side of the retail order, their job is to either internalize that trade or hedge it onto another venue as cheaply and as quickly as they can. But obviously, in some sense, they're being compensated for that. So we try to do that ourselves a little bit more efficiently sometimes, and also a little bit more within the same platform before it goes out to these external parties for hedging. And what that allows is, again, we can keep more of it within the protocol. We like to call it not leaking the value externally.
Right. So you can internalize some more of that activity rather than hedging it out to some third party. You can fulfill more of it yourself.
And Lucas, does that just scale based on volume? Your revenues are simply scalable linearly based on volume?
Roughly. I don't want to overpromise here, but one thing that we're excited about, I'll just use the general comparable that market making is a business that gets more efficient at scale, not less efficient. So we're excited about the fact that we've already been able to achieve some reasonable scale with OLP and Variational at our current activity in crypto. But as we get bigger, we're able to offer even better and better execution to our users because of the economy of scale, because of internalization, as Rob was just mentioning, and a few other things. So these are, one facets, and I don't want to get too technical, but these are like a few facets of the way in which we can, kind of, again, have that virtuous cycle of providing really, really high quality execution, zero fees, great aggregation of liquidity, but still generate revenue. And over time, I hope, indeed, more revenue as volumes go up.
Lucas, this might be a silly question, but the Robinhood example feels like it's a good comparison for a variety of reasons. You mentioned, payment for order flow. The Wall Street bets era, 2020, 2021, GameStop meme stock craze happened on Robinhood, and it was very, very at the center of that whole wave. I'm curious because Variational is also doing payment for order flow. Robinhood was doing that. Robinhood kind of got in this situation where it halted trading on GameStop because it was maybe favoring market makers, right? Because those were ultimately the customers. How do you prevent Variational from falling into a similar position where you guys are halting the retail traders because you've got to protect the market makers?
Well, a few key points here.
Sure.
Number one is, not to nitpick too much on technical terms, but I would not call Variational payment for order flow, since, as I was saying, it's very conceptually similar in terms of where is the money coming from or the revenue coming from, but we are kind of filling the other side of the order ourselves and then passing on the hedging flow, as opposed to letting a market maker fill the other side directly and then paying us for that. That's the payment for the order flow side. But again, very close in terms of concept, but it does allow us to keep that revenue within the platform and return some of that value back to users over time. That's part of our vision. Secondly, as far as it relates to the GameStop and so on, one interesting thing that I'll point out, which might be a little bit too much of debate tactics, just attacking the premise, but I think this does become more and more of a concern when we're talking about nonlinear derivatives, things like options and so on. If I recall correctly, that was the main instrument being used by a lot of the retail speculators. Yes, it's possible to very quickly have certain dealers get into hot water, let's just say broadly with the trading dynamics that we had around that time. This is very different for linear derivatives. It's very different for the types of relationships and even the way we have constructed settlement procedures and the relationships on the other end of the flow. And it's also a reason why we're working towards redundancies on the liquidity provider side, and all sorts of mechanisms to fairly protect the users. So it's top of mind. I think it is something we think about. But on the other hand, at the risk of dodging the question a little bit too much, it doesn't have as much of a direct analog to risks that I would necessarily consider day to day on the things that we're listing right now.
Yeah,
Lucas,
understood.
One of the things that Rob, one of the things that I love about this whole perps kind of dynamic that's ongoing right now is that it almost resurfaces this like integrated versus modular or modular versus monolithic kind of conversation. You could argue you've got a couple of these lighter hyperliquid operating on their own chain, hyperliquid 16 nodes, much more of like, less secure than a lighter's ZK proofs have just been reran effectively as of like this week. Suggesting that you can exit the chain, given any event, you don't need any help from the admin wallet or from the multi-sig. And so there's a lot of like ZK things happening there that make that pretty cool. Hyperliquid, on the other hand, much less secure, I think you could argue, in terms of their node architecture as well as their multi-sig design. And then you've got Solana's been absolutely at the helm the last week with Toli and Phoenix Trade, just a smart contract on Solana. Variational, similar, built on Arbitrum 1, kind of has an interesting technical setup there. Lucas, I'm just curious, like, where you stand on the optimal infrastructure design for perps, right? Obviously, you need extremely fast execution. You want security. You want all of your users to be safe. And then there's also the composability question. How do you think about the optimal design for a perps exchange, and why have you chosen to build on Arbitrum and kind of do things in the way that you have?
Yeah, there's a nuanced answer to this question, which I'll try to unpack a bit, but I think it's an important one to ask, right? Because at the end of the day, what this really gets at is two sides. One is user experience, and the other is security and trust, right? On the user experience side, you mentioned things like quick execution. I'd even just say like easy deposits, right? Like bridging, what's the wallet infrastructure look like? Of course, for any kind of large scale like L1, like a Solana, or any built out L2 like an Arbitrum, these are relatively solved problems. So let's kind of check that box a little bit. In terms of transaction throughput and some of the more nuanced reasons why, for example, Lighter runs on their own L1, and it's very impressive technology. I did see the ZK proofs as well. Like, I think their team's doing a great job. But they make specific technical decisions because what I was saying earlier, like they're building a price discovery venue, they're building a limit order book. They have to build for high frequency traders and different use cases than what we're considering. At the end of the day, on Omni for perps trading, we're obsessed with the idea of like a retail trader, right? Not an institution, not a high frequency trader. We try to solve user experience problems and therefore the technical problems that come up for that use case. For RFQ, a common misconception I see taking a small detour is that RFQ is, for example, like has extremely high latency or bad execution. On Omni, your quote request is getting refreshed in real time. It's a few milliseconds, right? Like for any normal trader, this is very, very fast, right? But it is true that like Omni is not built for HFT. So, certain of our technical decisions as it related to building on Arbitrum 1 and our ability to do that in terms of the block times did come downstream from the fact that we use just a completely different architecture. But again, the architecture is solving for TradFi liquidity on chain and the best use case for retail, not for HFT price discovery, which is just very different. As it relates to the other side of your question, which is kind of the privacy and security, and let's just call it safety side, that is a big reason why we chose Arbitrum. And again, this isn't to the detriment of other great chains like Solana and many others, but in particular, right, I think users can trust, like we are running their capital, we're running the system transparently on Arbitrum 1. If you sign up to Variational, you deploy your funds into what we call a settlement pool. It's a new smart contract that we spin up for every single user. You can see it there. It's on the main Arbitrum 1 chain. There's some value in there that I feel. So this is a very high quality, I think, substrate for us to build on. And in terms of kind of the spectrum of, let's say, hyperliquid to a lighter, and there's a lot of things that could go into how we compare those. But I think that they're built with different sets of trade-offs. I think Variational kind of straddles somewhere on that spectrum. But the bigger things we were thinking about was, again, how do we solve for trust and security? And then how do we solve for the UX side? And I'm happy that with the decisions that we made there so far.
Given that there's a lot of trade-offs that are made, across this entire spectrum, some are built more high frequency, some are built more for execution. We've also been talking a lot on the show about the power law and how, this market feels as if it's getting more mature, and you have the leaders that are starting to run away with the game. Do you think that there's room for, several perpetuals exchanges to all compete for market share? Or do you think that this follows the typical power law, kind of 4 to 2 to 1 ratio of, what a 2 to 3 winner market could look like?
Firstly, I'll separate that question into exchanges versus brokerage-like models, where we're really competing in a second piece. In fact, the Fortune article that went live a little bit earlier used an important quote where I think I was saying, we don't view Hyperliquid and Lighter as direct competitors in many ways. Yeah. As I said, exchanges are an infrastructure layer piece. They're a very necessary piece. We can and will trade on those types of venues in the future in the same way that we trade on many other exchanges. Just like I'm mentioning how we're aggregating TradFi liquidity. We're a user of, downstream in some sense of CME and CBOE and these types of exchanges kind of through our tech stack. I'll hand wave a little bit. But, we don't see that as a direct competitor. To answer on the exchange side, because I think that's an interesting one, I personally think that there is a power law and that there will be a small set of winners. And there's a lot of economy of scale there, right? Like as we described, order books, you have to build up that liquidity and have those maker relationships. And there's a lot of an economy of scale. So do I think it'll just be one long-term? Not necessarily. But do I think there's going to be 10, 15, 20 exchanges, specifically limit order book exchanges? Maybe not, unless we are really segmenting by product in the same way we have different global exchanges or exchanges for derivatives versus spot in the US. As it comes to brokerages, firstly, this is a wide open category. It's something we're really excited about, or broker-like, let's say. So this is asking the question of if you build a retail facing product and try to, again, solve for aggregation and zero fees and so on, it looks very different. I think we're one of the first in this category that's going to scale out, and we're very excited about that. I'm sure there will be more. Brokerages are something that we see specialize in various geographies and product types. I mean, think of how many you can think off the top of your head, say in the US market, Robinhood, Fidelity, Schwab, et cetera, et cetera. We'll see different carve out different parts of the ecosystem, but at the same way, in the same example, of course, there are a few big winners and they become durable because users are sticky. And we think we can give them, for example, for us, a great product and have a very durable edge there.
Beautiful. Lucas, last thing from us, any words to the variational community, the early traders, the early OLP adopters and depositors and users, big raise, RWAs are out. There's a lot of excitement. People are kind of coming back to the market. If you're watching a few markets, it's a giga bull. If you're watching the majors and some other markets, you're down bad. People want to feel something. Any words to the community?
Well, to our community, I think first it always has to start with a thank you. As I think Rob was mentioning, quoting a couple stats a little bit ago, it's been amazing to see the adoption of the Variational platform. It's been great to see it hit product market fit to kind of prove out our brokerage-like model, our zero fee trading model. And then, this is what we're delivering, our ultimate vision. We partner with Dragonfly. We have the capital we need, the partnerships we need, and we're bringing the TradFi liquidity on chain. But it's a big thank you to everyone who's been there early in the process with us, using the early versions of Variational, helping be part of that journey, helping prove out the model. And it's up to us to continue to scale it from here. But to the community and even to people who might be familiar with Variational for the first time from some of the press we're doing today and this great conversation, try out the platform, share the feedback with us. There's tons of new RWA markets coming soon. I hope more than 100. We're actively hiring. We check Discord every day. We are a crypto native team in that sense. We are deeply plugged into our community and we're constantly watching. So many of the best ideas, listing requests, et cetera, come directly from our community. We'd love for more people to be a part and to help us usher in this new era of RWA trading on chain.
$50 million Series A.
Shout out to the new hire, Justin. Let's go, man. Yes, sir. Let's go, Lucas. Great episode. Thanks for joining us, man.
Yeah, thanks so much for the time, guys. Really fun chat.
Thanks. Yes.
Man. Variational, man.
$50 million raise.
Series A.
Yeah.
Huge raise.
I mean, on the heels of
raise.
Hyperliquid just pumping. It's incredible to see.
Justin some love, the new hire. Steady lads. Steady lads. Rob, sorry, what were you saying?
I just think it's incredible to see, obviously perps as a category is exploding. Hyperliquid's leading the way. And I'm just, I think what is currently being slept on is this category of brokers. And I personally was unfamiliar with how these are ultimately going to benefit and be complementary with Hyperliquid and exchanges. Perps as a category is so much bigger than just one of these components.
I mean, yeah, Hype's at 52, Lighter's up another 12% today. Variational announced their raise. I mean, look, it's all coming together, right? Yeah. I mean, these valuations, Hype's now 50 billion. Lighter's at like $1 billion.
Exactly.
Variational is kind of like the third musketeer.
Yeah.
They're really in the race. Those are the big three. Aster was once part of the question, but I just don't really think anyone takes them seriously. And the technical design is not there. I think Variational's technical design is definitely there. I think Lucas is really, really bright. I think the biggest breakthrough is order books like Hyperliquid, like a Lighter. You need to get liquidity for every new asset. The RFQ model, you can have dozens and dozens and dozens of TradFi assets on chain, and you don't need the same liquidity management system because you can aggregate the liquidity through the RFQ model, which is kind of like the main breakthrough, I think, from their design and probably what got a lot of the investors excited.
Exactly. Yeah. Well, we've got our next guest on the heels of
Clarity.
Something that is going to help out quite a few projects, quite a few asset classes. Clarity is coming. And we're going to hear from
Cody,
the leader of the Digital Chamber of Commerce, Cody Carbone. Let's go ahead and bring him up. Friend of the show. Cardi, welcome.
What's going on, guys? How are we?
We promised that we're not going to talk about Clarity at all on the show until something happens. But here we are. Things are happening.
Clarity is my breakfast, lunch, dinner. It's all anyone asks me about, so I'm ready for it.
Good, man.
Let's talk about it. Cody, we heard some news is happening underneath the surface. Things are progressing through Congress. Could you just give us the updates? What everyone wants to know. What is the latest on the Clarity Act?
Sure thing. So it was a huge week last week. We're coming off a little bit of a high. We had a bipartisan vote out of the Senate Banking Committee, 15-9. The bill now progresses. And so where we are right now is that there's really two pieces of this bill. There's the portion of the bill that passed out of Senate Banking Committee last week. That's the portion of the bill that has jurisdiction over the SEC. And then there's the portion of the bill that has jurisdiction over the CFTC. And that it passed back in January out of the Senate Agriculture Committee. So what has to happen next? We have to take these two bills and make it one. We got to put it into one bill. We have to reconcile the two bills. We need one product. So the Clarity Act needs to just be one bill. That's ultimately going to be voted on the Senate floor. So over the next 2 to 3 weeks, staffers on both the Ag Committee and the Bank Committee will be putting these two bills together, continuing the negotiations to get ready to put this on the Senate floor, where they're going to need 60 votes. So while it's great that we had 2 Democrats vote for it out of Senate Banking Committee last week, we need at least 7. And that's if you have every single Republican, 53 Republicans. You need at least 7 Democrats. There's a group of 12 Democrats that have been working on this over the last few months. So the goal over the next 2 to 3 weeks is to finalize negotiations with them, bring this one product to the Senate floor, hopefully the 2nd or 3rd week of June is what we're looking at. Pass that bill on the Senate floor with a bipartisan vote. Then it's got to go back to the House one more time, because what the House passed last year, which feels like decades ago, is a substantially different bill. So the House is going to have to vote one more time. And after the House votes, and you would hope that if it passes the Senate with a bipartisan vote, the House will pass it with a bipartisan vote as expected. This thing goes to the president's desk, and they're hoping early July, a July 4th signing ceremony. But sometime in July, President Trump signs this, and Clarity is enacted into law.
Incredible. So July 4th seems like the target. That would be ceremonious indeed. You mentioned if we work backwards here, obviously we've got to pass the House and the Senate, then it goes to President Trump's desk. It seems like if we pass the Senate, the House is a foregone conclusion. So the blocker right now, and you said the time frame here is the first couple of weeks of June. We need 12 Democrats, and that's assuming all 53 Republicans. Break this down for us, because Polymarket is still just pricing a 56% chance that Clarity Act is signed into law in 2026. Before the high of last week, we were at 46% chance. So we've jumped 10%. This is movement in a positive direction. When we're going from, the subset of the Senate to ultimately, the full Senate, and we're going from, this initial cohort that voted this and passed it, and we're opening this up into all Democrats and Republicans in the Senate. Who are some of the swing voters here? What is the likelihood that we ultimately get this past the House on the first try?
I'm focused on that group of 12 because I feel confident that maybe all 53 Republicans are unlikely, but at least 51, 52. There's only really going to be 1 or 2 Republican defections. So who are this group of 12 that can carry this to the 60 vote threshold? You need 60. 60 is the end game. It's all about getting to 60. So if you look at the 2 Democrats that voted for it out of Senate Banking Committee, Senator Gallego and Senator Alsobrooks, it's a great start. But there was 5 other Democrats in Senate Banking that voted for some bipartisan amendments to push this forward. Right there, you've got 7 Democrats. If you get all 53 Republicans, you only need those 7. So you're looking at Senator Warner from Virginia, Senator Kim from New Jersey, Senator Cortez Masto from Nevada. Then you're looking at some of the other senators that are not on banking, but that have been a part of this cohort of 12 that have been really trying to push this forward. Looking at the Senate Agriculture Committee, Senator Warnock, Senator Booker from New Jersey, who's been leading negotiations on the ag side, Senator Klobuchar, who's the ranking member on the ag side. I'm focused on the Democratic votes. I think if you can pick off, and I think you see the path right now, and that's why I'm so optimistic. And actually, I think the Polymarket odds are a little low right now if I was a betting person, and I am. But you can find the path by looking at the Democrats, and that's not even including Senator Gillibrand, who's had her name on this bill from the very beginning, who's not on one of those 2 committees. So there is a path. I would focus on those group of 12 Democrats who have been working on this. We met with Senator Gallego, who was one of the 2 Democratic yes votes in the Senate Banking Committee. We met with him at Consensus in Miami, and he said, hey, I think there's a path here to not just get 60 votes, but to get 70. I think why I'm so optimistic is that these senators, both Republican and Democratic side of the aisle, have been prioritizing this. This isn't an issue that they came to a markup, and we watched thousands of markups like this, where they said, okay, this is going to be a partisan exercise. All the Dems, hey, we're just going to sit here and vote no. All the Republicans vote yes, or vice versa. The Democrats are engaged. Now, even though it's only been, about 6 days since we've had the markup, we've already got staffers on both the Republican and Democratic side figuring out, okay, all right, what's next? How do we get to yes? How do we continue to negotiate on ethics? Or how do we continue to negotiate on developer protections to make sure everyone's aligned there? So I feel really optimistic that there is a path. Obviously, things can go wrong. It's not done until it's done. DC is famous for missing deadlines. There's a lot of things that still need to happen, but there's a huge opportunity for every single one of your listeners, every single advocate out there, to continue to reach out to their senators. Because I can tell you, while we've been focused, to your point, Rob, on the Senate Banking Committee and the Senate Ag Committee, there's about 60 other senators who are not focused on digital assets whatsoever, who probably haven't thought about this since they had to vote for the Genius Act last year, who need to be educated and reminded why they care. And the one thing that we want to make sure at the Digital Chamber that never happens is that a senator goes up to vote and goes, man, I haven't heard from the crypto industry at all. Or I didn't hear from any of my constituents why they care about this bill. So what's my incentive to vote for it? I'm not hearing from the constituents. I'm not hearing from the businesses. I'm not hearing from anyone. So I'm not taking this seriously. You've got to reach out. Call your senator, tell them why you care about this, tell them what this will do for either your business or your own personal investments and holdings and the different use cases of this technology. It can make a world of difference, but I feel sitting here, May 20th at 2:30 in the afternoon, I feel pretty good that we can get this done.
Yeah, hell yeah. And are you satisfied, Cody, with the current form of the Clarity Act? I know there were some changes and there was some negotiations and some, tug of war going on. Or is the Digital Chamber, is Cody Carbone satisfied?
We feel good with where the bill is right now, but the key part of that phrase is where it's at right now. I mean, what we will not be willing to sacrifice, where there are some discussions of, behind the scenes negotiations, are sacrificing developer protections, sacrificing the Blockchain Regulatory Certainty Act. If you're a non-custodial developer out there, you need the protections that are in this bill. We can't weaken some of those protections. We can't negotiate our way out of the US being the crypto capital of the world. It can happen very easily here. I've watched it happen over time, not with this bill, but when you're so desperate to get to 60 and you're so desperate to get to yes, you're willing to sacrifice some of the key components of the bill. That can't happen here. To the credit of the White House Crypto Counsel, the Republicans who have been pushing for this bill, like Senator Lummis, Moreno, Scott, the Democrats who have been on board since the beginning, they haven't gotten to that place where they say, you know what, we need to sacrifice something that is really going to kill the key tenets of this bill that allow crypto to flourish. I'm most focused right now on those developer protections, on the Blockchain Regulatory Certainty Act, which would exempt certain infrastructure providers, miners, validators, node operators from being financial institutions. We can't sacrifice those. We can't weaken those. As long as the DeFi protections, developer protections stay strong, we'll continue to feel good. Overall, I do feel like this bill provides the clarity that the market needs where the U.S. can continue to flourish. But we'll be watching very closely, and we'll be a part of the negotiations going forward to make sure it remains that way.
Yeah. And following up on where, we had sort of left off on the Clarity Act, and like Andy mentioned, we had been talking about it for, almost every day. And then it felt like, okay, we got to take a break here until something really happens and we can revisit it. The last we heard, was effectively that this yield issue was the hang up. We've overcome that hurdle. Can you just, give us a synopsis on what the outcome was? What was the conclusion that we reached with the yield issue? Is that a done deal now?
It's a done deal if you ask me. Now, I know there are some Democratic offices, and the banking lobby has been very, very vocal that they are going to continue to push to alter the yield language because they were not satisfied with it. To your question, Robbie, of where we ended up and why I think it's a done deal. So what the provision of the bill right now, it's section 404 in the banking bill, says that it is prohibited to offer stablecoin yields rewards that are economically or functionally equivalent to an interest-bearing deposit. So effectively, if you're holding USDC idly in your Coinbase wallet or whatever, you're holding your stablecoin and you're not moving it, you're not just going to get rewards for just holding it. The only way that rewards will be permitted is based off activity or based off transactions. So if I'm going to send, you or Andy a stablecoin, I can get rewards for that. If I'm going to lend, if I'm going to use stablecoins as collateral, if I'm going to stake my stablecoins, like if I'm staking USDT on MetaMask, I can still get rewards for that. Why I ended up feeling comfortable with the final language. Again, it's not perfect. I would love if there was no prohibitions on rewards and we kept the status quo, but it just wasn't going to be the case. I felt comfortable because there's also a rulemaking right now that's part of this bill that says, okay, Treasury Secretary, SEC Chair, and CFTC Chair. In addition to those permissible activities to pay out rewards that I just mentioned, come up with a longer list of what else is permissible where you can pay out rewards. And I'm sitting there and I'm looking at it, I'm saying, okay, you got Paul Atkins, Mike Seelig, Scott Besson, these three agency heads. Who better than to come up with what is permissible to pay out rewards than these three guys who have been huge advocates for stablecoins and stablecoin rewards and stablecoin payments. So I feel good. Again, it's not perfect. The banking industry has been very clear with us, or I said the banking lobby has been very clear with us. They were never going to be happy unless there was a blanket prohibition on all rewards. Any type of rewards or stablecoin yield that exists, they're going to be unhappy with. And they've made that clear. So they're still fighting. But why I feel confident that this is now done is that Senator Alsobrooks and Senator Tillis, the Republican and Democrat who put this compromise together, have been very clear, like, hey, banking lobby, we asked you to come to the table. You refused to negotiate with us. We think this is the best compromise. We like stablecoin rewards. We think there is a good use case for them. We think this is positive for consumers. We're not going to ban them. You were never willing to negotiate. This is a done deal. Republicans and Democrats, the White House, they're all saying that now. So the bank lobby had their chance. They missed it. There's still some supporters they have on the Democratic side who have been pushing amendments, but they all were voted down in the markup. And I feel confident that they'll all be voted down as this bill progresses.
Yeah. Awesome. And, you mentioned a couple of the other issues here that are still up in the air. Developer protections is one of them. Are these the most contentious issues now? We're past yield for the most part. Maybe, we get some reshuffling there, but what are the most contentious issues now that are holding up some of these Democrats?
Yeah, you just mentioned, I would say, probably the most contentious substantive issue, and then there's ethics. Okay. And ethics, we've stayed out of that. Is a direct negotiation between Senate Democrats and the White House, and it all is around government officials, the president, really, but government officials and how they interact with digital assets. That's more of a political issue that, again, we're staying out of. That's the number one issue to get Democratic votes on this. That has to be resolved. I feel confident that it's on a path to getting resolved because the Democrat that is leading that is Senator Gallego, who voted yes in the markup. Okay. So that shows me that there is a positive, there's positive momentum and this can get done. But developer protections, and I'd say DeFi as a whole, there's still a lot of misunderstanding, misconceptions that relates to DeFi. There's still a lot of offices who are scared about DeFi. It doesn't help that there have been some letters from different law enforcement groups over the last few weeks coming out against some of the developer protections in the bill. I actually think this bill is overwhelmingly net positive for law enforcement, creating clear rules, more regulations, enhancing the Bank Secrecy Act in some section. So it provides more transparency for law enforcement and actually provide more tools for them to do their job in finding criminals. We shouldn't be messing with non-custodial developers. We shouldn't be treating them like financial institutions. We shouldn't be treating them like broker dealers. What is that going to do, if anything, but send these developers offshore? That doesn't help law enforcement. Law enforcement can't go after bad actors if they're operating offshore. So it's a lot of education that needs to be done for some of those offices. I'm confident that we'll get to a good point. And the fact that we have the bill right now still has preserved those protections makes me feel good. So that's by far the most contentious is ethics and DeFi.
Yep. Cody, kind of flipping into the more recent kind of rumor announcement from the SEC that was kind of leaked across a couple news channels is this innovation exemption for tokenization. I'm not sure if you had a chance to really kind of dig deep into that one, but essentially there was this ruling that came out about issuance of tokenized stocks and securities and equities on chain without requiring permission from the issuer to do so, and kind of this evolution of ruling that supposedly could come out as soon as the end of the week, sometime next week, that would suggest that these tokenized equities on chain would be required by the SEC to fulfill the fullest extent of their voting rights, shareholder rights, dividends, etc. And platforms or venues which do not uphold this same level of shareholder rights would have their rights removed to be able to offer these products on chain. And so there was kind of a couple different lines in the sand here that were drawn. But I'm just curious if you've heard any rumblings in DC around this innovation exemption, kind of what is happening here behind the scenes. How is this progressing, if at all?
Yeah, and it's hard to comment on the substance, to your point, Andy, is like we haven't seen it yet. But what I can offer is that we have heard it is imminent. And it's not breaking news. A lot of people have talked about it, but in our conversations with the SEC, it does seem like it is imminent that this will be released very, very shortly here, if not by the end of this podcast, the end of this week. So it's pretty fascinating. What it tells me, and this sentiment has been echoed from the chairman, Paul Atkins, but really from the SEC Crypto Task Force when we first met with them. This was even before the Trump administration came into power. But in December of 2024, when we first met with them, they said, hey, everything is moving on chain. Everything is being tokenized. We need to find a way as a regulator. Our goal is not to stop these products or to stop the innovation, but our goal is to make sure that it can be done safely and within the rules. And so it is no surprise to me that as more people are offering tokenized equities, or that there's more retail and investor demand of tokenized equities, that the SEC is saying, okay, we need to find a way that people can offer these in the United States, do so safely. And then what are the rights that are required for people who are going to invest in a tokenized Apple stock or Tesla stock or whatever? So I think there's going to be a lot more of this from the SEC in finding opportunities for some of the innovations and disruptions that we're seeing from the blockchain community, digital asset community, to find a way to not say, hey, you can't do this, because that is not this SEC's role, but saying like, okay, that you're doing this. We understand there's demand for this because you're doing this. How can we make sure that as a regulator, we're keeping up so that you're protected? So I think tokenized equities, tokenized bonds, tokenized really every financial instrument will start to have more guidance and rules from the SEC of how those can be offered in the United States. 24/7 trading is already happening. We'll probably see that, and I would imagine there's going to be a lot more guidance from both the SEC and the CFTC on 24/7 trading. But we are moving into, and I wouldn't be surprised by the end of the Trump administration, is if that all markets are on chain, and we're moving 24/7 trading 7 days a week for everything. The
Fascinating.
SEC has embraced it.
Yeah, it really is happening, and it feels like this is accelerating that trend. Both, the Clarity Act coming through and the innovation exemption. Cody, my last question here is, obviously the draft of the Clarity Act is already publicly available. We can all read it. The innovation exemption is rumored. We're starting to make, get a better understanding of what the rules are. Signing these things into law would help to cement that. It would also help regulated entities come into this industry, and it would add more competition in that sense. Are there any large changes? Like, we know you speak to policymakers and legislatures, very, very frequently. Kind of speaking to the builders for a second, what are there any recommendations that you can make as to say, hey, here's something you need to prepare for. Here are things that you should be, thinking about as you guys you're starting to reshape your business post clarity, post innovation exemption. What are these things that people should have in mind for the changes that we can expect once these things are signed into law?
The biggest one is, I think what clarity being signed into law allows is comfortability that if you're building in the United States, or if you're building offshore and you've always had intention of coming back to the United States, that you now know that you can do so safely. It's going to take a while before you know the full effect and force of the law. So in Clarity Act, there is 40 plus different rulemakings that the SEC, CFTC, some other regulators are going to have to write the rules to how to make the law come to life. That's probably going to take 2 years. they're probably going to have in the bill saying, hey, you need to have these done before this administration is out of power. So we're looking at, like 12/31/28 before this bill is truly implemented into law. It's just similar. It's very similar to the Genius Act right now, where there's an 18-month implementation period before you can truly be Genius Act compliant. Is not till January 1, 2027. So I would say be comfortable, be ready to come back to the United States or to continue to build here. You should feel very safe and secure. However, pay very close attention to those rulemakings. Participate in those rulemakings. Don't just let, I mean, you can join the digital chamber, gladly take you, and we'll be your voice in some of those rulemakings, but respond. I mean, they all have to go through a public notice and comment period. And I can tell you from talking to these regulators, they will read every single one. They'll read every single response. So if you're building in this space and you think that there is a way that they're going to implement regulation crypto, or that they're going to implement, the licensing regime for a new digital commodity broker, if that's you and you're going to be affected by this, participate in that, because you'll have 2 years to make sure and to help the regulators really make this law come to life. And if you sit that out and then you come back, or you're operating in the United States, just January 1, 2029, when these rules are effective, you say, hey, this doesn't match my business, or I can't comply with this. Well, if you didn't participate, you've really got no one to blame. So pay attention. The Clarity Act being signed into law is huge. It can give you the comfortability that you can build here in the United States. But there's going to be a lot of steps that you need to follow and pay attention to for how your business is going to comply.
Yeah.
Beautiful.
Cody, thank you so much, man. It's really helpful to get, the on the ground, in the trenches insights, from the guy fighting the good fight. Really appreciate you taking the time to help us out understanding this.
Anytime, fellas. Anytime for you guys.
Yep. And if you guys are watching, make sure you call your senators in the States. Give them a call. Is that how it works, Cody? You can just give them a call?
Give them a call. It is the most effective way. I can tell you from working in a senator's office previously that every time the senator leaves, and it doesn't matter who it is, they'll say, hey, any calls today, and what they call about. And if that staff assistant sitting at the front desk who's answering the phone say, hey, we got 20 questions on crypto, you really got to pay attention to this Clarity Act, that changes everything. That's where they start to really pay attention. So give them a call.
And who are the 5? You mentioned, there's 12, but we got to get to at least like 7 or 10. What are the states that are the most contentious right now?
I would say Virginia, Georgia, Arizona, Minnesota, New Jersey.
Okay.
Anyone there, and I should make a shameless plug. The Digital Chamber will have a call to action feature on our website that you can find, where you can go on, find who your senator is by putting your address, and it'll give you a prompt and a script and the number to call your senator. So go on our website.
That is elite.
Yeah.
Beautiful.
Cody, thank you, man.
Thanks.
Have a great rest of your day. I know you're busy.
No, it's great. Great being with you.
Cheers, buddy.
See you next time. Thanks, Cody.
Bang, man.
It's a great update.
Bang. Cody, the man.
There we go.
The man, the myth,
well,
the Digital Chamber CEO.
He's in there.
We're making progress. We're making progress. It
DC.
sounds closer than ever.
Yeah, it's very cool. It's going to make some impact for sure. And it's exciting to see. It's exciting to see it move up based on what he's saying. And obviously he's pushing on this 54%. What we're seeing on Polymarket does feel a little bit low.
I was almost like, is that insider trading? But it's like, nah, this is a public podcast. Alrighty, guys, we've got Plume's general counsel, Salman. We had him on last week in Bermuda. Needless to say, whatever happened in Bermuda did not stay in Bermuda because they got something done. They got a new license to basically expand tokenization. We're gonna hear more about it from Salman. We're gonna get down into exactly what that means for Plume, for the tokenization of all assets on chain. Again, we've seen multiple announcements this week that are just signaling to the market that tokenization is a very, very important priority. So let's get Salman up on the show. And last but certainly not least, Salman, welcome back after Bermuda. Good to have you, man.
Yeah. Thanks, guys. Glad to be here.
Yeah, man. Big day. Let's not bury the lead.
Congratulations.
Plume has been granted a license from the Bermuda Monetary Authority. We were talking about this last week as well. Generally, just after they put out this tokenization report that I know you guys helped with some of that. What does this enable someone? How did this happen? Give us the story here a bit.
Yeah, so the license lets us tokenize assets out of Bermuda. So at a high level, we will be enabled to launch new RWA, real world asset tokens out of our Bermuda entity in a regulated way, subject to the Bermuda Monetary Authority's oversight. They have experience regulating a variety of different digital asset businesses. The two templates that they drew from in looking at how to regulate Plume was Kraken, particularly Kraken's work with X stocks in terms of tokenizing equities, distributing them through Kraken, and then those tokens being permissionless, so they flow into DeFi. And then the other template is stablecoins. So stablecoins, primary markets, primary distributions come under KYC, but secondary distributions into DeFi are subject to AML at the blockchain level. So at the token level. So yeah, those are the two templates. We really focused on one particular use case, which is the Nest protocol. So the Nest protocol is a vault protocol that we've developed. It's basically on-chain asset management software. It lets curators use the protocol to create vaults. Vaults hold reserve assets that appreciate or generate yield, or depreciate or have negative yield. And so it's basically a on-chain native way of creating asset management products with either portfolios of multiple assets, or the structure is also used because it's asset management native to create feeder funds for let's say US or Hong Kong or other jurisdictions as asset management products. And that's actually been the primary use case of Nest so far. And so, yeah, we had to work with the BMA to come up with a regulatory architecture. There's elements of crypto regulation here. So, the cybersecurity approach, the BMA is very sophisticated in thinking about, the on-chain supply chain and the cybersecurity risks at all the different levels of the supply chain. So we had to do, a number of different things, audits, penetration testing, things of that sort. To meet kind of that cybersecurity. Then there's AML. As I mentioned, the AML is embedded at the token level. And so the approach there is very much aligned with what we see in the Genius Act for stablecoins. So it's transaction monitoring and freeze and seize and burn remit capabilities that need to be implemented subject to policies and procedures. So it's pretty robust on the crypto side of things, and it's also robust on what I'll call the more TradFi side of the regulatory regime. So effectively, we will be, as a vault curator, acting as an asset manager, and so the key regulations there around asset liability management, proof of reserves, conducting liquidity testing, making sure that the liquidity of the token matches with the liquidity of the underlying. And things of that sort, which we see in the SEC's liquidity risk management rules, for example, as well as the BMA's rules applying to funds operating out of Bermuda. So it all came together quite nicely, and our goal has been to for the asset issuers, for the asset managers, to provide them a well-regulated feeder vehicle that they can work with. Also gives us the option of creating our own asset management products. And the license will also be useful as we look at tokenizing other types of assets that may not even use the vault infrastructure. So yeah, we're very excited. It's and we plan on making great use of this license to increase confidence in vaults and in tokenization generally.
Yeah, it feels like the first of many. It feels like this is the first step in what we're going to see as the new standard for vaults on chain. I think it's worthwhile just kind of reading a bit from the announcement itself, so people get an understanding of how it works. The Bermuda, subsidiary of Plume, is effectively this regulated on-chain vault. It's effectively like the next evolution of an ETF. Users deposit assets, receive proportional shares, they earn yield, and they can redeem it at net asset value. Unlike traditional funds, everything runs on smart contracts on chain. Curators can manage and rebalance these assets within these fixed hard-coded rules amongst these vaults. This subsidiary is the first regulated vault curator licensed to create and distribute vault tokens under AML standards. Salman, I have, I guess, two questions, somewhat unrelated, but the first one is, we've obviously got on-chain vaults right now. These are present in DeFi. The fact that this is a regulated on-chain vault, I'd imagine that the primary change that we go from unregulated to regulated is access. We open up access to a new cohort of potential depositors, and this increases the potential size and market size of these vaults, maybe tenfold, hundredfold. I'd love to hear you speak to that. And then the second question I have is a little bit more in the weeds around how this token level KYC AML works. Is it freely transferable? If I have this asset, I deposit, I get this vault token. Can I just send it to you or send it to Andy? Do you guys also need to opt in or KYC? How does the transferability of token level KYC work for these RWA products?
Yeah, that's a great question, Rob. So I'll take the first one to start, which is, how do we see the vault market growing? So I'll just give you a little bit of a timeline on how vaults have kind of moved to the fore of the policy picture, which indicates kind of their movement to the mainstream. So back in January, the Senate's Clarity Act bill included a definition of vault tokens and asked the SEC to update their rules. That prompt to the SEC made its way into the version of the bill that got voted out of committee last week. So this is, and then Chair Atkins, I think this was about a week and a half or 2 weeks ago, also indicated that as a part of his Project Crypto, that they were looking at rules around the use of vault protocols by U.S. asset managers. And so Bermuda has, in a sense, front run the SEC and Congress on this front. And just like we saw with the rise of regulated capital markets, it's only when you have this third-party assurance that the asset management product isn't a rug pull, are you going to see new sources of capital moving into the space. And so that's one of the big unlocks. And as you know, the asset management industry is multi-trillion. As it moves on chain, vault infrastructure is kind of the natural place for asset managers to move their fund administration capabilities. So we hope to chip away at that multi-trillion-dollar asset management market piece by piece. And so this is an unlock there. And then on the AML piece, so we got to put an asterisk. I think there may be some other vault managers that have regulatory licenses. My understanding is, though, ours will be the first that enables permissionless distribution of these assets. So the token itself does not require whitelisting. These tokens are built in the same way as, for example, the XStocks tokens that trade through Kraken, with primary distribution happening through an institutional partner such as a centralized exchange, and then the token itself having within it embedded AML controls. What are these AML controls? So we will screen every transaction involving the token against an illicit wallet database provided by TRM Labs. So making sure that transfers don't happen to illicit actors. And then embedded within the token is automated logic to freeze and enable law enforcement to seize the assets, and also to burn and remint tokens if downstream we find out that there's an illicit actor type situation involving the token. So it's very much aligned with the emerging standard for stablecoins, and I'm hopeful that as regulators think about how to balance AML risks with tokenized investments, tokenized securities, they'll use a similar approach, globally. So yeah, we're pretty excited to be pioneers in that space.
Man, most definitely. And I think, I had been asking people about, are vault curators and vault managers something similar to an RIA? Like, how do you differentiate this? I'm sure there's going to be regulatory clarity on this or action on this. One of the two. It seems like this is kind of a step in that direction as far as defining what a vault manager really is, right? And so I think that's super important for the industry at large, not just for Plume, but for the industry. And Salman, I think, this week has been insane on the tokenization side because the SEC also just put out this innovation exemption. Last thing from us here is just, curious. I know it's not really defined yet, but I'm just curious how you're thinking about this lack of permission required for issuing tokenized equities from the issuer itself, requirements of dividends, voting rights, full shareholder rights on chain, or risking a revoking of rights to list these products on certain venues and platforms is kind of how we saw it be described, at least kind of in the rumor mill, if you will. Just curious, like, what you think about this innovation exemption kind of news, and hearing it's very imminent from Cody, Carbone, the CEO of the Digital Chamber, just a couple minutes ago. Any thoughts, insights, what this could mean for Plume, for the industry, for tokenization here as we kind of come to a close?
Yeah, I think the SEC is subject to a number of constraints, particularly around the Bank Secrecy Act and the rules around transfer agency. Both of those require KYC from different perspectives. I think the innovation exemption is moving faster than maybe revisions to those rules. And so that constrains the SEC's ability to create a broader exemption that would be maybe more DeFi native. So what I'm expecting out of the innovation exemption, based on public statements that Chair Atkins has made, is that it's going to basically allow for conditions that mirror the conditions that an ATS would have to comply with, but using a DeFi protocol. And so ATSs are subject to the Bank Secrecy Act as broker-dealers. And so they have to discharge that duty, by ensuring that all the participants in a particular trading system, in the case of a traditional ATS, or in this case, whitelisted liquidity pools, have been KYC'd. Now that's suboptimal from a ability to get these assets into the wallets of users outside the U.S. that may be unbrokered or have difficult access to U.S. products that might otherwise want them. And so what I see emerging is pathways to get those assets permissionlessly on chain. Perhaps with controls similar to stablecoins and the BMA as it relates to tokenized investments. And so what you may end up seeing is, tokenized ADRs. That would be, if I were the SEC, that would be a superior approach than, a less regulated model where, you may or may not, as a holder of these tokens, have a claim on any asset. And in the case of ADRs, the economic, or I should say the certain rights associated with the equity are stripped out in order to facilitate the distribution of those securities outside the U.S. And so we may end up seeing something like that emerge outside the U.S.
Got it. Interesting.
And so you think this innovation exemption, when it applies to U.S. investors, could look differently from what an abroad or international exemption could look like?
Yeah, I mean, we'll see. This is speculation on top of speculation.
Yeah.
But if I had to predict today, what the market structure for U.S. securities will look like, I think we'll very clearly see a U.S. market structure and then a global market structure that lives in parallel with it, with the latter designed to maximize distribution and the former maybe balanced more heavily to address traditional U.S. financial regulatory goals.
Makes sense.
Love it. Salman, man, congrats again, man.
And this is supposed to release in the next week or so. So we'll have to get you back on pretty soon once we can get some clear guidelines and not speculate.
Yeah, for sure. I'm excited to see it.
Very
Us
cool.
as well. Congrats, man. It sounds like the trip to Bermuda was well worth it. I know it was hectic, consensus to Bermuda, back to ZEC, but congrats on the license. Big moment for Plume, big moment for tokenization at large. And now excited just to see what Nest could be, right? As a result of this, as being a licensed vault manager. So shout out to Bermuda as well and the premier. He's a character, but he gets stuff done.
He does. And I don't think he had a hand in this, but he was definitely excited about this. So yeah, we talked to him a few times about it. So yeah.
Very cool.
Great to have political leadership like that.
Absolutely.
Definitely.
Congratulations again, Salman. Thanks for joining us as always. And we'll see you again next time very soon.
Thanks, gentlemen. Take care.
All right, sir.
Bye.
See ya. Man, the space is just going. I mean, it's going. I mean, it is going. Let's check in. Zcash 650, Hype 51, tokenization, innovation exemptions, Plume Bermuda license, Clarity Act. I don't know, man. I don't know.
I think you might know. I think we might.
Let's check the chat.
I think we might have
Variational
something
summer.
going on here.
It's a variational summer is what we're seeing in the chat, Rob.
It certainly seems that way. That is for sure. I mean, you just look outside, you see the sun, you see it's a variational summer. You can tell just by looking out the
Beautiful out
window.
there today.
You look out one side, you see, the Statue of Liberty, you see variational. You look out the other side, you see New Jersey, you see Hyperliquid. So it is an absolutely buzzing out there in the heat, summer in the city.
Ladies and gentlemen, that's the roll-up where digital assets meets finance. If you're watching on YouTube, hit the like, hit the subscribe. We'll be live tomorrow, 12:30 p.m. Eastern. Rob, signing off here, man. Always a pleasure.
Pleasure as always, all mine. Guys, keep your
To
hands.
my Zcash and Hyperliquid Warriors.
It's good to have you again. Back into the real digital assets.
Let's go.
See you again tomorrow, guys.
See you guys.